Here's a tech giant you probably use every day, HP. Its stock is so cheap that its PE ratio is under 10, and it offers a nearly 5% dividend yield. Doesn't that sound like a golden opportunity to buy a bargain? But when you think of HP, you probably picture that dusty printer at home and its shrinking printing business, feeling like it's just an outdated sunset company. But what if I told you that, out of sight, HP's 3D printing technology is quietly helping BMW and Ford manufacture car parts, sparking an industrial revolution? This is HP's biggest contradiction. On one hand, Wall Street is overwhelmingly bearish, saying its core business is obsolete. But on the other hand, it holds two trump cards for the future: the AI PC revolution and 3D printing. So, is HP a once-in-a-lifetime value investment opportunity, or is it a boiling frog trap designed to slowly bleed your money away? In this episode, we'll break it all down for you. Hey everyone, welcome to the debate. We have only one goal here: to cut through all the market noise, challenge the prevailing narratives, and help you find the clearest path forward in this confusing market. Without further ado, let's get started.
Ladies and gentlemen, let me start by introducing HP, a company you probably know better than you think. Every time you print a document at home or use a laptop at work, there's a good chance you're using HP technology. This $53 billion revenue giant has two main cash engines. They're the world's second largest PC maker with a 20% global market share, and they dominate the printing industry with both printers and the profitable ink cartridges that go with them. Their revenue splits roughly 60% from PCs and 40% from printing, both generating billions in steady cash flow. Now, why should you buy HP stock today? First, let's talk about incredible value. HP is trading at just under 10 times earnings. That's incredibly cheap for a technology leader. To put this in perspective, most tech stocks trade at 20 to 30 times earnings. Yet HP is generating nearly $3 billion in free cash flow annually and returning billions to shareholders through dividends and buybacks. You're getting a 4.6% dividend yield that's like getting paid while you wait for the stock to appreciate. But here's where it gets exciting: the future potential. We're witnessing the biggest PC upgrade cycle in years. Two massive catalysts are converging right now. First, Windows 10 support ends this October, and Microsoft's extended support costs $427 per PC over 3 years, forcing businesses to upgrade. Second, the AI revolution is creating demand for AI-capable PCs, and HP is perfectly positioned as a market leader. HP isn't just riding this wave, they're ahead of it. By the end of this fiscal year, they expect 25% of their PC shipments to be AI-enabled. That's transformation into higher-margin, premium products. But here's the game changer: HP's revolutionary 3D printing business. While everyone focuses on traditional products, HP has quietly become a leader in the next industrial revolution. Their 3D printing technology isn't making plastic toys. We're talking about manufacturing real automotive parts for BMW, Ford, and Volkswagen. General Motors used HP's technology to produce 60,000 critical car parts in just 5 weeks. The global 3D printing market is exploding, growing from $2 billion today to a projected $128 billion by 2032. Their competitive advantages are rock solid: strong brand recognition, global distribution networks, over 11,000 patents, and $4.3 billion in annual R&D investment. They've created profitable, recurring revenue through printing supplies, and now they're applying that expertise to manufacturing. Here's my bottom line: you're buying a profitable, cash-generating market leader at discount prices, with multiple growth catalysts accelerating right now. While others chase overvalued tech stocks, smart money recognizes that HP offers both established market leadership and explosive growth potential from revolutionary technologies. Thank you.
Thank you for that passionate opening, but let me bring some hard facts to counter those optimistic projections. First, let's address that Windows 10 upgrade catalyst. My opponent claims Microsoft charges $427 over 3 years, but they conveniently left out the real story. For consumers, it's just $30 per year. For businesses, it's $61 for year one. Many companies will simply pay this small fee rather than replace working computers. There's even free options through cloud backup. This isn't the massive forced upgrade cycle they're promising. Second, that revolutionary 3D printing business. Here's reality. HP's 3D printing revenue is so tiny they don't even break it out separately in their financials. You're being asked to bet on a $25 billion company based on a side project that might succeed someday. But here's the real problem. HP's core businesses are fundamentally broken. Their printing division, which generates 40% of revenue, just posted a 4.3% decline in their latest quarter. Both commercial and consumer printing are falling simultaneously. Operating margins dropped from 18.4% to 18.2%. This isn't temporary, it's permanent digitalization. When was the last time you printed something at home? Their PC business operates in a commodity market with razor-thin margins. HP has already lost market leadership to Lenovo and faces brutal competition from Dell. Even with that supposed AI PC growth, analysts just downgraded HP because the benefits won't materialize until 2026 or 2027. Wall Street isn't buying this story either. In just the past few months, HSBC downgraded from buy to hold, Citi downgraded from buy to neutral, and Morgan Stanley cut their price target. Multiple analysts cite weak guidance, commodity cost pressures, and concerns about the printing business decline. That 10 times earnings ratio isn't a bargain, it's a warning sign. When a stock trades at half the market multiple, it usually means the business is in trouble. HP's own management just slashed earnings guidance by 12% and cut free cash flow projections. Ladies and gentlemen, my opponent wants you to believe you're getting a technology leader at discount prices. What you're actually getting is a declining printing company with a commodity PC business, hoping a tiny 3D printing bet pays off decades from now. When the stock is down 30% and analysts are downgrading, sometimes the market is simply right. Thank you.
Thank you. My opponent raises concerns, but let me set the record straight with hard facts. First, let's talk about that Windows upgrade cycle. Yes, Microsoft offers extended support, but here's what they're missing. Security and productivity aren't optional in 2025. When cyber attacks cost businesses an average of $4.45 million per breach, no serious company will risk running unsupported systems to save a few dollars. More importantly, AI PCs aren't just about Windows, they're about competitive advantage. Companies using AI-enhanced workflows are seeing 20 to 40% productivity gains. You either upgrade or get left behind. And here's proof it's already happening. HP's commercial PC business grew 9% year-over-year last quarter. Their AI PC penetration hit 15% already, and they're on track for 25% by year-end. These aren't regular computers. They command higher margins than standard PCs. This isn't speculation, it's measurable business growth happening right now. Second, my opponent cherry-picked one quarter's printing decline while ignoring the bigger picture. Yes, home printing is down, but commercial printing and HP's services business are growing strongly. Their Instant Ink subscription service now has over 10 million subscribers paying recurring monthly fees. That's predictable, high-margin revenue that keeps growing even when hardware sales fluctuate. But here's what they completely missed. HP just reported $3.3 billion in free cash flow last year and returned $3.2 billion to shareholders. That's not a company in trouble, that's a cash-generating machine. My opponent also ignored HP's $4.3 billion annual R&D investment and their leadership position in the fastest-growing segment of manufacturing, 3D printing. While they focus on last quarter's numbers, I'm focused on next decade's opportunity. Here's the bottom line. You're getting a dividend-paying, cash-generating market leader at a massive discount positioned perfectly for multiple growth waves. The question isn't why the stock is cheap, it's how long this opportunity will last. Thank you.
Thank you. My opponent paints a very exciting picture, full of massive catalysts and revolutions. It sounds great, but it ignores the cold, hard reality of the market. They're betting everything on a giant PC upgrade cycle. Let's look at that. First, the end of Windows 10 support. They believe this will force everyone to buy a new PC. But let's be realistic. In the current economic climate, many businesses will find it much cheaper to simply pay Microsoft's fee for extended support for another year or two rather than spending thousands on new hardware. This massive wave is more likely to be a slow trickle. Then there's the AI PC revolution. Right now, this is more marketing hype than a real-world need. Ask yourself, what can an AI PC do today that your current laptop can't? For most people, the answer is not much. There's no killer app driving demand. Furthermore, HP has no unique edge here. They use the same chips from Intel and AMD as Dell, Lenovo, and everyone else. It's not a revolution for HP. It's a brutally competitive, low-margin race just to keep up. And let's not forget what my opponent conveniently glossed over, the printing business. They call it a cash engine. I call it a melting ice cube. Every single year, the world prints less. This isn't a cycle. It's a permanent structural decline. That highly profitable ink money is drying up, and it's never coming back. So, when you strip away the buzzwords, you're left with a company facing a sluggish PC market and a printing business that is slowly disappearing. Don't be sold on the hype. Look at the fundamentals. Thank you.
Thank you, ladies and gentlemen. You know, my opponent reminds me of someone looking at a Ferrari for sale and saying, "Well, it's parked in the discount lot, so something must be wrong with it. Sometimes the best deals hide in plain sight." Let me leave you with this simple truth. HP generates more free cash flow than many tech darlings combined, $3.3 billion last year, yet trades at a fraction of their valuations. That's not a red flag. That's a green light. While my opponent worries about yesterday's headlines, 3 massive waves are building right now. The Windows 11 security deadline that no serious business can ignore, the AI PC revolution that's already delivering higher margins, and a 3D printing market exploding from $28 billion to $128 billion. HP sits at the center of all 3. Here's what makes this investment beautiful in its simplicity. You're buying a profitable company with a 4.6% dividend that dominates 2 essential markets, computers and printing, while getting explosive growth potential almost for free. So let's bring it back to basics. We're talking about a company you know. A $53 billion revenue giant with 2 main cash engines. The world's second-largest PC maker and the dominant force in printing. Both businesses generate billions in steady cash flow. That is the foundation of this opportunity, and that is why HP stock isn't just a good buy, it's a great buy. Thank you.
Ladies and gentlemen, thank you for this engaging debate. My opponent just painted a beautiful picture of HP's future, 3 massive waves, explosive growth, and revolutionary technology. It sounds wonderful, doesn't it? But here's the thing about beautiful pictures. Sometimes they're just that, pictures, not reality. Let me give you the real summary in plain English. HP's printing business, which generates 40% of their revenue, is dying. Not sick, not temporarily down, but dying. People don't print anymore. Businesses are going paperless. This trend isn't reversing because of some magical 3D printing side project that doesn't even show up meaningfully in their financial statements. Their PC business? It's a commodity market where they compete on price with Lenovo and Dell, those higher-margin AI PCs my opponent mentioned. Even HP's own analysts say benefits won't show up until 2026 or 2027 if ever. And about that $3.3 billion in free cash flow they're so proud of? Well, when you're cutting earnings guidance by 12%, slashing jobs by the thousands, and watching both your main businesses shrink simultaneously, that cash flow looks more like a going-out-of-business sale than a growth story. Here's my favorite part. My opponent says this is a green light opportunity. But when a stock falls 30% in a year while the market rises, when Wall Street analysts are downgrading left and right, and when management keeps cutting guidance, maybe, just maybe, that's not a green light. That's a flashing red warning sign. You know what they say about catching falling knives? Sometimes the smartest move is to just let them fall. Thank you, and remember, the cheapest stock isn't always the best bargain.
All right, over to you, the judges. What do you all think? I'm looking forward to seeing your votes and thoughts in the comments section. We love hearing what you have to say. and I believe every perspective brings something valuable to the table. Also, I've done my best to fact-check the information you've just heard, and you can find the relevant links in the description box below. Before you go, don't forget to hit that like button and subscribe. Your support means the world to us. We'll see you next time. Bye-bye.